Assalamualaikum warahmatullahi wabarakatuh. Hi everyone, my name is Siti Atilldhia Thunovtufi. I am the moderator for today's presentation. We are from Group 5 will present about investment. First of all, I want to introduce the member of our group, Reva Dwi Ardiyani, Siti Atilldhia Thunovtufi, and Zahra Anggraini. First presentation material will be explained by Reva. So Reva, time is yours.
Okay, materi is investment reasons. There are three reasons why corporations invest. Firstly, corporation might have excess cash. If the company have excess cash, this is not good for the company. So the company chooses to invest. Second, to generate earning, a company invests to get return and earning. When a company invests at product, it will record investment, revenue, or dividend. And finally, to meet strategic goals, when the company accrues shares as a shareholder, the company has control over the company where shares are purchased. There are two types of investment: debt investment and share investment. Investment in debt securities or investment that are investment in government and corporate corporation bonds. Stock investment are investment in the capital stock of the corporation.
Okay, thank you, Reva, for the explanation. Next, I will continue the presentation, which is about debt investment and share investment. There are three entries to record investment in debt securities. First is acquisition of bonds. Second is bond interest. And the third is the sales. First, recording acquisition of bonds. At the acquisition date, what we will record as debt investment are all costs incurred, namely the price for bonds and broker. For journal entry, debt investment in debit and cash in credit. Investment are assets, so that's why debt investment are in debit. Second, recording bond interest. Calculate and record interest revenue based upon the carrying value of the bond times the interest and times the proportion of the years the bond is outstanding. And for the journal entries, it will be interest receivable in debit and interest revenue in credit. And last one is recording sale of bond. When selling investment in the form of bonds, we will calculate the selling price with the investment value. If the sale value is higher than that investment, there is a gain. The journal entry will be cash in debit, debt investment, and gain on sale of debt investment and credit. Meanwhile, if the sale value is lower than the debt investment, there will be a loss. The journal entry is cash and loss of sales of the investment debit, debt investment and credit. Investment in stock securities, recorded depending on the number outstanding share purchased by the company. For share ownership, it is classified into three: less than 20%, between 20% and 50%, and more than 50%. For ownership of less than 20%, it will be recorded using the cost method, and the presumed influence on investing is not significant. For the ownership of between 20% and 50%, it is recorded using the equity method, and the presumed influence on investee is significant. And for more than 50%, you can use the cost method or equity method. The presumed influence on investee is significant and has control. Holding of less than 20% using cost method. First, the journal entry to acquisition of stock is stock investment in debit and cash in credit. Two, the journal entry to dividend is cash in debit and dividend revenue in credit. And last one is the journal entry to sell stock. If loss, cash and loss on sale of stock investment in debit and stock investment in credit. But if gain, cash in debit and gain on sale of stock investment and stock investment in credit. Holding between 20% and 50% using the equity method. For acquisition, the cost and equity method are the same. Stock investment in debit and cash in credit. However, it is different in receiving dividend using the equity method. Because the company has shares between 20% and 50%, the ownership is significant, so that when the investee announced net income or revenue, the investor will recognize the investee's share of profit equal to proportion of ownership as an addition on the investment value. And for the journal entries, our share investment or stock investment in debit and revenue from share investment and credit. Then, when the company or the investor receive the dividend, it will reduce their share investment. And the journal entries are cash in debit, and share investment and credit. Post-transaction for years, its investment and revenue account will show the following. As can be seen from the stock investment ledger, on January 1st, is the purchase of share amounting to $102,000, and on December 21st, in debit is recorded as revenue, and December 21st in credit is recorded as receiving dividend. And the total balance will be 138,000. And for the revenue from stock investment is on December 21st, it will be 30,000 in credit. Holding more than 50%. A company that owns more than 50% of common stock of another entity is known as parent company. The entity whose stock the parent company owns is called the subsidiary company. Because of its stock ownership, the parent company has a controlling interest in subsidiary. When a company more than 50% of common stock of another company, it usually prepares consolidated financial statement. And the next feature that is going to explain by Zahra. To Zahra, time is yours.
Okay, I will explain about investment assessment and reporting of investment. For purpose of valuation and reporting at a financial statement debt, companies classify debt investment into three categories. This is trading securities, available for sale securities, and held to maturity. Meanwhile, Stock investment are classified into two categories. This is trading securities and available for sale securities. The first trading securities. Trading securities are bought and held primarily for sale in the near term to generate income on short-term price difference. The second is available for sale securities. Available for sale securities are held with the intent of selling them sometime in the future. And the last one is held to maturity securities. Held to maturity securities are debt securities that the investor has the intent and ability to hold to maturity. Trading securities. Trading means frequent buying and selling. Companies adjust trading securities to fair value at the end of each period. So they report changes from cost as part of net income. The changes are reported as unrealized gain or losses. The unrealized gain or loss is difference between the total cost of trading securities and the total fair value. The fair value is the amount for which a security could be sold in the normal market. The picture shows that the company have unrealized gain of $7,000 because total fair value is greater than the total cost. At the end of period, the company will report fair value and unrealized gain or loss through an adjusting entry. In this entry, company use fair value adjustment trading account to record the difference between the total cost and the total fair value of securities. If the total of the trading securities is greater than the total fair value, an unrealized loss has occurred. In this case, company record the adjusting entry is a debit to unrealized loss income, and a credit to fair value adjustment trading. The next is available for sale securities. As indicated earlier, companies hold available for sale securities with the intent of selling their investments sometime in the future. Companies report available for sale securities at fair value. The procedure for determining fair value and the unrealized gain or loss for the securities is the same as for trading securities. In the first picture, there is an unrealized loss of $9,537 because total cost is greater than total fair value. In the adjusting entry, companies identifies the fair value adjustment account with available for sale securities, and it identifies the unrealized gain or loss account with stockholders' equity because company don't expect to sell the securities in the near term. Thus, prior to actual sale, it is more likely that changes in fair value may change either unrealized gain or losses. Okay, the next is balance sheet presentation or short-term investment. Short-term investment is readily marketable when it can be sold easily whenever the need for cash arises. Short-term investment intend to convert means that the management intends to sell the investment within the next year or operating cycle, whichever is longer. Short-term investment appear immediately below cash in the current asset section of the balance sheet. The next balance sheet presentation for long-term investment. Companies generally report long-term investment in a separate section of the balance sheet immediately below current assets. Long-term investment in available for sale securities are reported at fair value. And the last one is in long-term investment is investment in common stock counted for under the equity method report at equity. The classic balance sheet in this illustration includes the statement about short-term investment and long-term investment, which is hiked in red. The investment in short-term securities are considered trading securities. The long-term investment in stock of less than 20% owned companies are considered available for sale securities. This illustration also includes a long-term investment report at equity and descriptive notation within the investment, such as the cash flow method for valuing inventory and one note for the statement. Okay, that's all for me. I will return to the moderator. Thank you.
Okay, thank you, Zara, for the explanation. That's all from Group 5. Thank you for your attention, and we apologize for any mistake we made. Wassalamualaikum warahmatullahi wabarakatuh.